How does Michael Burry take advantage of tax loss harvesting? That's what we're going to talk about today. And as you can see, Mike Burry is real excited about this topic. That's okay, Mike. It's interesting. I promise you do it. But we're going to talk about this with the help of Brandon from MacroOps, and he's our resident value expert. So both him and Burry are value guys, so Brandon will help explain what exactly they do. But before we get into that, I got to tell you the NASDAQ All-Stars is open. This is my momentum system, which is different from value, but it still works real well. And in my opinion, it's like 100 times easier. It's all automated and all back tested and pretty much tells you what to do. And that's how I like it, so I could spend minimum time trading because I got other stuff to do. Now, access to this closes Sunday, so if you're interested, definitely check it out because I'm not going to open it up again until probably June. So it's going to be a while. I'm going to put a link to this video right here that explains the system a lot more. I'm going to put that link down below in the comments and description. So click on that link, watch this video, and then on this video, you'll see the link to actually sign up if you're interested. But okay, back to tax loss selling or harvesting. So first of all, what is tax loss selling? Well, all you're really doing is selling your biggest losers to shield the gains you've made in the rest of your account. It's just a tax strategy because you're allowed to offset losses. So if you lost $3,000 on a stock investment, you can take that and use it to offset profits on the rest of your account or otherwise on your ordinary income. It's just the government giving you credit for losing money. It's like the one time the government cuts you some slack and feels bad for you. The rest of the time, they're just taking your money. So that's why people just love this idea of tax loss harvesting. Now, a lot of investors do this, like retail investors and professional guys. But for value guys like Brandon and Mike Burry, this creates opportunity. And that's what we're going to talk about, how you can use other people selling their losses to your advantage. So most of the tax loss harvesting happens around Thanksgiving and Christmas. The deadline is usually around the last week of December because that's the end of the year, right? And there's a cutoff point for your taxes. So tax loss harvesting happens for a few reasons. The first obvious one is to shield any gains from investments or ordinary income. So that's what I explained before. You're showing the loss to offset those gains so you don't have to pay taxes on them. But the second reason, which is a big reason too for professional managers, not as much as retail, is for advisors and fund managers to window dress their portfolio. Now, I talked about this in the Santa Claus rally video, but we'll go into more depth here. So the thing you got to understand when you're a professional money advisor or manager is that you're playing a different game. Guys who aren't in the industry think, okay, if I go professional, then all I got to focus on is returns, which is primarily true, yeah, but there's also a lot of other things, a lot of business things. Like raising capital is a huge part of being a professional, depending on your specific job, of course, but a lot of times, yeah, it is, especially if you're managing your own fund. And the other thing is client management. So this window dressing falls kind of under that client management because as a manager, you're getting evaluated every quarter and every year, right? And if you have a bad quarter or a bad year, your clients are going to take their money away from you. So that's why some of the best investors, especially this year and the last few years, there's been tons of redemptions from their funds. Money has been piling out. And that's because like these are the greatest investors, right? These guys are amazing, but their client might not understand that. They don't understand how the market works, how it goes through cycles. Sometimes the strategy works and sometimes it doesn't. Just like Buffett, he may underperform for a period of years, but then knock it out of the park when it's the right time. But investors don't understand that you got to go through those rough patches to get those nice times. So they start pulling their money, even when it's a really famous investor with a great track record. So what a lot of portfolio managers have to do is kind of like dress up the portfolio. So the way they can do that is by exiting their clients' biggest losers, exiting turnaround projects, and removing small cap companies. So exiting the biggest losers. Once you get rid of that stock, then your client isn't going to pay as much attention to it. So when they look at the portfolio, they only see stocks that have performed well that year and gone up. So they're happier. And then exiting turnaround projects and small cap companies. Well, these things are always going to be more risky. And for professional fund managers, depending on what they're doing, they can't take that much risk. Or I should say the risk to reward in their own career is not there. So think about it. If you do just as well as the next guy, right? You all match the index, then you're all safe. But if you take a risk in your portfolio as a portfolio manager and you think, okay, I got to get into this turnaround or this small cap, it's going to be huge. Well, if it is huge, then okay, great. You made better percentages than the next guy and you get a nice bonus. You might get more capital inflows too. But if the risk turns out to not pay off and goes to zero and loses the client's money and you get your performance down on your portfolio, then then you run the risk of losing your job. So this is why you see a lot of fund managers are just closet indexers. They're basically like buying SPY and holding on, because you're not going to get in trouble for doing as well as the next guy, but you take a risk and screw up, then you're going to be screwed. So one of the things they do, as it says here, is exit all those risky investments. You don't want to show the client that, especially when it didn't work out. So Michael Burry even talks about it in his investor letters. He said, indeed, as the quarter came to a close, the stock came under renewed selling pressure, presumably as other investment funds work to window dress their portfolios for public viewing. Some element of early tax loss selling may have played a role too. So this is something that Burry tracks, like he knows it's a factor that plays into these stocks getting beat up. And I should also explain, Brandon and Burry, they're value guys, right? So they're looking for stocks that are undervalued. So a good way to find these undervalued stocks is when you tap into a psychological thing like this, like what these professional fund managers are doing. Why they're doing it, and they're doing it every year, it's a structural thing at that point. And obviously when they're selling, it's pushing stocks down even more, and that creates that opportunity because they aren't being sold because their value has gone lower, but because of this tax loss harvesting and window dressing. So that's the whole idea of this strategy of how these value guys like Brandon and Michael take advantage of this. So if you want to find these types of stocks where this is happening, first thing you want to do is scavenge the 52-week all-time low list. These are stocks that are down 40, 50, 60, even 80% in a year. So the point is, most of the investors that bought these stocks are probably in the red, and they'll want to sell before the end of December for the, reasons we've already discussed. Another great way to find these stocks is just in thematic movements of the year. So in 2019, oil and gas got beat up, so you'll probably find a lot of those names getting hit with this tax loss harvesting. So Brandon says any stock that's down over 50% is a good candidate for more tax-related selling pressure. Now, a lot of these stocks that are going to be down that much, they're going to be terrible stocks. Like, you don't want to catch a falling knife here. They've dropped 80% for a good reason. So you still got to do your value analysis and find the ones that are actually good companies that got hit even harder with this selling because of this tax loss harvesting. So here's how Brandon does it. He puts together a watch list of 10 to 20 stocks that he thinks are going to get hit hard with the tax selling and window dressing. But then he dives deeper into those names to make sure they're not trash. So here's what he's looking for: companies with little to no debt, because those guys aren't going to go bankrupt. It's very difficult when you don't have that debt weighing over you. He also wants to see a potential catalyst for earnings or revenue growth, so kind of a turnaround play. And he wants to see insider ownership, because if the guys who own the company are buying more shares, then clearly they know something. And a big thing he also uses to help him are charts, which I know value guys don't, or they're not supposed to use. But Brandon's a smarter value guy. And obviously I love charts when I'm trading momentum, just like in the NASDAQ All-Stars. So like, this makes perfect sense to me. And at MacroOps, we would always look at the value guys' fundamental theses and then put our technical analysis over it, because you don't want to be sitting with dead money. And the technicals tell you when the stock is ready to move. So like Brandon says here, he uses charts to see when the downward momentum has been exhausted, because you don't want the thing to keep falling when you're about to buy it. You want it to base. And then once the consolidation occurs, he buys around the low price support or after a breakout from that range. And as he explains, this strategy relies on mean reversion. He's not looking for the best businesses to hold forever. He's looking for ugly businesses that are oversold and overlooked. So these might be shorter term plays even for a value guy. So here's a few stocks that he's looking at. The first one is Medifast, M-E-D. As you can see, it's been nice and beat up this year. Doesn't look like it's basing just yet, but the company trades at 16 times earnings and 9 times EBITDA. They have zero debt and an activist investor who recently took a 15% stake in the business. So it has a lot of the characteristics you want in these types of stocks: a cheap price, no debt, and incentivized management. So the value investor Bill Miller actually took a position in this company. And he says if it reaches its 2021 target, it'll be trading for only 10 times earnings out a couple of years. And he thinks that the company has the potential to double. It's always nice to have other smart value investor guys being in on something before you get in, because they've usually done a lot of the due diligence for you. Of course, you got to do your own research too, but it's a good signal. Another one that Brandon is looking at is Kirkland's. And no, this isn't Costco Kirkland brand like I thought it was. It's a specialty retailer focused on home decor and gifts. I don't know, I've never heard of them, but you can see how hard they got hit this year, and it actually does look like they have a bit of a base going on. So it's down 87% year to date, but the shares are liquid, so if people want to sell, those managers that have this company, they'll be able to sell it off. And the company is a $16 million nano cap stock. So any advisor caught with something that risky, they're going to be in a lot of trouble. trouble, so of course they want to sell it off. Company has zero debt and is trading at an 88% discount to book value. Last year they generated 15 million in EBITDA. That's almost its entire market cap. So the company is losing money, but it has also bought back 1 million shares over the last 6 months. So clearly it looks like there is some value here. Next stock is TripAdvisor, which has also had a terrible year. So the stock price keeps falling even though TripAdvisor has grown their revenue, cash flow, and paid down all their short-term debt. So despite that, they're down 48% this year. Wow. Share prices actually haven't been this low since 2012, and in 2012 they generated 736 million in revenue, but last year they did 1.6 billion, and yet the share price is the same. So the company trades for 12 times free cash flow and 9 times EBITDA, so it's very cheap. And again, with value, you're just looking for things that are misvalued, so investors aren't looking at it right, or they're undervaluing it. By nature, it's going to be a contrarian play, just like you'll see in this next one. And this next one is GameStop, which you can see they've been getting hit hard for years now. And GameStop, if you guys remember from all the articles that came out this year, is one of Burry's big investments. So he's been actively pushing for massive share buybacks. And the stock is actually up over 30% since Burry sent a letter to GameStop's management. And you can see that right here. And again, if Burry is in GameStop, then you know there's some type of value there. And he explains his bull thesis over the next 2 to 3 years. We expect GameStop's business will perk up a bit during 2020 and 21 as the new console cycle with the software updates and introductions finally gets underway. But what's happening now in the stock is about more than late cycle doldrums or even the streaming paradigm. Shareholders do not have faith in current management and have not been inspired by new leadership policies. So GameStop, it's not an easy investment, but there is potentially a lot of value there, at least according to Burry and Brandon. So there you have it. That's how you can take advantage of tax loss harvesting that other investors are doing. Now, me personally, I like to do things a lot simpler. That's why I trade momentum. And that's why I have this NASDAQ All-Star system, which again is only open till Sunday if you're interested in checking it out. Go click below this video and it'll take you to this video where I explain a lot more about what the system is. And on this video, you can actually go sign up for it. You can see I'm wearing the same thing in this video that I'm wearing in this current video because all I wear in my life are black tees. Let's be honest, there's no way around it. But I'm very happy in my black tees. Thank you. And yes, this is a different black tee every time because, you know, I like to stay clean as well. But anyway, check out that link down below so you can learn more about the system. It's only open till Sunday. And if you haven't already, make sure you subscribe to this channel and hit that notification bell so you get email notifications for more videos like this. Subscribe and I will see you in the next video. Stay fallible out there. Bye.